Right, hello and welcome. This is an OCR AS blah blah economics video. So, what we're going to be doing about today, we're going to be doing about the balance of payments. So we're going to be doing about the capital, financial and current account of the UK, and we'll be assessing the advantages, disadvantages, mainly to the current account because that's the main one you're interested in for this level. So let's kick off and get pen first. Maybe hopefully this will work. If it doesn't, never mind. But I want to do crazy world, crazy. So, let's we start off with. Well, I'll just put the balance of payments at the top. Probably should have done that at the start. Now, as I said, it's separated into the current account, the capital, and the financial account. Right, so we've got these three accounts. Now, the first thing you have to ask yourself is, why am I jumping about? Well, just keep you interested. But the other thing you need to ask is, what are these? I mean, current, capital, and financial. What does it actually mean? Well, I'm going to be focusing more on this one, but we will go over these two. So the first one I'm going to talk about is we're going to talk about the financial account. Actually, this is mainly just put a little thing here to do with investment. Really, it's just the money flowing in and out in terms of investment. So one of the types of investment we've got is something called direct investment. Great, pen's rubbish. So, direct investment is not. You don't use the word direct when you're explaining it, but in essence, direct investment is where a UK business opens up in a foreign business and invests in that. So basically it's the outflow of money in terms of investment to a foreign country. Now if the money's flowing out, that's a debit to the UK. So direct investment, I just put in brackets spell investment. That's a debit as the outflow money from the UK, and it's investing abroad basically. The other one, which is kind of the opposite, is something called portfolio investment. Now, portfolio investment is, as you can tell, I just put portfolio I on it. It's just the opposite of direct investment. As you can see, direct investments where the money leaves the UK, so it's a debit item. However, portfolio investment covers purchase of foreign bonds, treasury bills or shares by UK residents, and the purchase of UK stocks and shares by foreign residents. So, so it's basically, it could either show basically this is to do with UK investing in the UK or foreign companies investing in the UK. Sorry, just trying to sum that up a bit better. So this is a credit, and it will give a positive reading for the current account, the financial account in terms of the balance of payments. So the credit, and that will be from foreign investment in the UK. Investing in UK And obviously the previous one's a debit because we're investing abroad. So I'll just put investing abroad. So that's the financial. There's one other thing actually. There's something. It's just generally any other investments. I just put other, as these are all to do with investment. The other one includes deposits held by banks. Deposits with banks held by UK residents or abroad. Yeah. So includes banks with deposits in banks held by UK residents abroad, or alternatively you have foreign residents in the UK and loans between UK and the UK banks and the government and foreign banks and governments. It's quite weird that. But anyway, this represents a positive figure, so it's a credit. You don't really need to know too much about this other one, apart from that the other investment is basically where we invest. We have deposits held abroad by UK us, or foreigners held in bonds, deposits in banks in the UK, and that's called other investment. So to just go over that again, the direct investment is where we're investing abroad. The portfolio investment is where foreign firms are setting up and investing in the UK. But obviously, if they take that money back, that's a debit. It's a money being earned in our economy and then just shoved off to some other economy somewhere else. Very nice then indeed. So, the capital one, we haven't talked about that. Now, this is these two, actually, the current and the capital, just before I start talking about them, they are intertwined in a sense that they are very related. So if one's negative, the other one's going to be positive. And generally, it's the capital being positive and the current being negative. So, the capital, what is it? Well, it's a very small part, and it includes capital transfers. You may be going, what's a capital transfer? Well, this is basically just like government grants, etc. So this is grants given by the government. Let's put government grants. I haven't made this very easy even for myself. Mind? I'll sack this. I just put grants and in bracket government. So it's just grants from the government. And so the government grants a new item such as debit forgiveness, which is the forgiveness of debt by a creditor by mutual agreement. So a creditor is someone who's owed money, so if they say yes, it's fine, the government will pay for that. That's a capital transfer. Now there's another one called the acquisition of non-produced, non-financial assets. So I'm not going to write that out because it's quite wordy, but basically, in a sentence, it's concerned with the purchase and sale of certain assets, such as land by embassy. So purchase of land by embassy, for example. So purchase of selective goods. I'll explain the link between these. E.g. in a minute. Each land bought, embassy. And then we have the current account. Now the current account is split up into 4 sections. The first section is how's it worded actually? Sorry, just let me check how it's worded so I don't get it wrong. Word it wrong for you. That's it, trading. Yeah, you got trading, goods. I'll just write them down, then I'll go over them. If I can spell as trading goods. And then we have trading services. There's another name for these two, which I'll go over in a minute. There's a lot of stuff I'm going to go over here. Trading services. And as well as them two, we have current investment income, which is a confusing one, but all you need to know really is these two, so I'll just underline them. Current investment income. And fourth and finally, we have current transfers. So, what are these? Well, trading goods is the imports and exports in terms of goods. So, it could be imports and exports of machinery, for example. So, I just put X/M of visible and physical, visible items. So, of visible items, e.g. machinery. So that's another name. These are also named as visible items, e.g. machinery. I just underline visible machinery. And by power deduction, this is X over M, or well, no, it's not divided by it. It's just exports or imports of services. So this is of invisible items, such as investment, for example. So I just put e.g. investment. Or insurance, for example. Investment. Sorry if you can't see my writing very well. Probably shouldn't be writing in the same colour. Never mind. Investment, e.g. investment, I'll just leave it as that. But you can know it's also to do with the insurance. Yeah. For example. So, this current investment income, it covers a compensation of employees' earnings arising from employment abroad and investment income. The former consists of employment income from cross-border and seasonal workers. For example, the earnings sent home by a British computer programmer working in Libya would be recorded as a credit item because it's money flowing into the UK. So basically, in a nutshell, number 3 just looks at the incomes coming in and out of the country. So I just put incomes under there as one word. So basically, if you've got a foreign person working, it's sort of related to what I talked about here, about credit and debits. So if you've got someone foreign working in the UK, which I've never seen before in my entire life, I have to say, which would be quite strange if that ever happened. But so if someone foreign is working for in the UK, sounds ridiculous, but you know, just go with it. And they send money back. I could say more than income, but I'm not going to. That they send back to their homeland for the families. That money's been earned in the UK, but it's not being kept there. It's being sent back to Poland or any other country in the world, and obviously that'd, you know, that's something a debit, because we're never going to see that money back. That exact £5 or how much they get given, and it goes back to the country. That's a debit. So that is what number 3 measures. It measures the incomes in terms of sending it abroad or bringing it in the UK, which we mentioned before. So that's incomes. Current transfers, that's where it's basically about government grants, that one. So I'll just put government grants. Government G. So government grants is needed in times where oh damn it, wrong one. That's not good. Yeah, I said that. So current transfers, can't believe I could mess that up. Yeah, the capital, that's government grants. I should have realised that, never mind. So, current transfers is to do with... So, sending out money to the European Union, for example, as the UK is part of the European Union, so we send money out, we get money back. But generally, to be a part of it, we have to pay it, and there's very little times where we get money, because the UK is rarely in situations as bad as the rest of the world. We've seen Hurricane Katrina might come to mind, for example. I know they're not in part of the European Union, America, I don't think. Which isn't a good start, but you know, that's just an example. We're sending money over there to help people who've been struck by a natural disaster. Actually, it's a better way of putting it. So that's the current transfers. Is transfers to the European Union, which is a central government transfer, or other sector transfers. So this could be workers, the taxes on income, and business people. Sent to foreign governments, not our government. Yeah, so the inland revenue by foreign workers in the UK appears as a credit item, as it's the other way round. As instead of sending it out, taxes from foreigners that are working in the UK and go to the government in the UK, despite the fact they're not British. So that's pretty much it, actually, for them 3 accounts. I will go over current account a bit more detail in a minute, but that is the overview. I mean, for these two, that's as far in detail for the capital and the financials we're going to go. So that basically overlines all of them. So the financial is to do with investment. You've got direct investment, which is sending money abroad, so say debit item. Yeah. You've got portfolio, which is generally money coming into the UK. For foreign investment, which is a credit item, and the other one, which is credit items, really, you don't need so much more than that. You've got the capital, which is capital transfer, which is government grants, which I talked about before. Purchase of selective goods, so basically government embassies buying certain land to build stuff on. You've got the current account, which is the main one, which is split up to 4 sections: trade of goods, trading services, capital, current transfers, and the income going in and out of different countries, which is sort of what we talked about before. And the current transfers is where sending money to the EU, which we get back, but generally this part of it is in deficit, and this generally is in surpluses. Government grants, we don't tend to pay them back, really. So that's a bit of a heads up on pretty much everything there. I'll just rub that off, give you a minute to copy that down. So basically, I'll just get rid of these. Oh, I could have left that on, actually, never mind. You can write it back down if you want to, but I'm not going to write it back up. I'll get rid of the balance payments, because I'm going to do like a mind map now of capital account. Sorry, the current account even. One day. Current. So, the current account. Now we talked about it being split into 4 sections. So the section of trading services, trading goods, capital, current transfers even, which is like transfers to the European Union, and incomes going in and out of the UK. So we might get a deficit or a surplus, but I talked about mainly a deficit because, well, that's what we're going to find out. So a deficit, what is a deficit caused by? Well, a deficit caused by... Now, just before I say these, I want you to take in the fact that you can switch these around or turn it on its head, so to speak. So, for example, if we're talking about a deficit at the current account, and we're going to list a couple of reasons for, the opposite of them will result in a surplus. Just by the power of deduction, I'll just let you know you can do that. So you don't need to think of them as 2 separate reasons. If you can reasons remember the reasons for the deficit on the current account. All you need to do is switch them around, do the old switcheroo, flip them on the head, and we get causes of the surplus on the current account as well. I was going to say capital, I don't know why. So, the current account is mainly concerned with exchange of goods and services. Is the main two you need to remember, and that's what I'm going to talk about really in this context. So, if we have a deficit, what that means is the government is sending, well, not the government, but we are buying more goods and services. Basically, net exports is minus. So we're spending more on exports than we are getting. Sorry, spending more on imports than we're getting exports. Revenue in terms of that. Sorry. So yeah. So a deficit that is can be quite bad depending on the duration. So if we are able to spend more on imports, which are generally considered to be a luxury good, then we have high incomes in the UK, because not everyone is going to purchase stuff domestically, which is produced in the UK, sorry, is what domestically means. So that must mean we are on high income levels in the UK. Alternatively, in the UK, now I've mentioned in the UK there instead of just put high incomes, and that's because if our exports, so mainly in the current account we talk about imports and exports, and obviously in terms of goods and services, capital current transfers such as the EU, and the other one which is about incomes coming in and out. But the main two at the beginning we're going to talk about here, these are causes for all of the current account components. Sorry, I need to plug in my laptop, give me a second. It started to die. Don't mind, eh? Life's too short to pause the video. You can watch me mess this up. Technology's a bit advanced for me, I would say. Ugh, God's sake, couldn't have happened the worst time. So, what we were saying then is, so for the current account you've got high incomes in the UK. Now if our exports are lower than our imports, we have a deficit on the current account, so that means there must be low incomes as our exports are not being bought. Inflation has not changed, we're assuming that, obviously, but according to the deficit it will, but something we'll go on to. We'll assume that at this moment in time we have no deflation in the economy. So that means that our export prices have stayed the same. So that must mean the income of foreigners has gone down. So incomes abroad is going down. Have reduced. So if incomes abroad have reduced, that essentially leads to our other thing, which is the exchange rate being ridiculously high. So exchange rate increasing, not necessarily increasing, that's quite misleading, but I'll just put a high exchange rate. So if our exports seem not as attractive, our high exchange rate needs to be in place. So basically what an exchange rate is the amount of money they need to buy our pound. So for every pound they need more of their alternative currency to pay for that pound. So without our prices actually increasing as such in terms of value, in terms of the pounds, they've increased essentially in the price of their currency, which we'll go into exchange rates in a bit more detail in a few minutes. So actually in the next video. So high exchange rate, that's all good. However, you've got to take into account countries as a whole, they produce goods and services. Now, although goods and services are not up to a sufficient standard, then it will start to affect their international competitiveness. So as it's not always solely dependent international competitiveness against other countries on price. It's also dependent on the quality. I mean, you're not going to want to import something that's worse quality than you can make here, otherwise you just simply buy it here. But obviously it's cheaper and better quality generally over fields. Well, generally it's more expensive, but it's because you import it. Never mind. Just assume that we were talking about the quality, so a deficit would be the quality of foreign goods and services increased. So quality of foreign goods and services, I just put foreign G&S, is increased. Now, what we're going to do, I'm going to get another colour, crazy, and do the causes for the surplus in the current account. So we'll do it over here. Now, I said you can sort of switch these around. So a surplus, so the causes of a surplus. If this is causing a deficit, if we do the extreme opposite, we're going to cause a surplus in the current account. It should be account actually underneath. In the balance of payments. So for high incomes in the UK, and we won't switch it around, there's going to be low incomes in the UK. Now, without just me saying that to you, I'll just go into a bit of detail about it. If there's low incomes in the UK, it's going to cost more to, it is costing more to import the goods. So we're going to say, for example, have a staycation. So that's just an example of spending money in the UK for spending it abroad. So that causes a surplus as we spend less on imports. Exports don't necessarily go down or change, but we're spending less on imports because our incomes are lower. So lower incomes in the UK. Again, we're going to do the opposite of the incomes abroad. So if the incomes were originally lower abroad for a deficit, for a surplus, which is the opposite, we're going to change that down to a 0. So increased incomes abroad. This is because, this relates to the surplus, because if incomes abroad are increasing, they can buy more of our goods, which is more appealing to them, rather than eating the same sandwich over and over again. You want to pay a bit more for an English sandwich, I mean, you wouldn't. So, incomes abroad are increasing, hopefully it's explained. High exchange rate. Now, a surplus, they're going to want our products to be as cheap as possible. So, without actually lowering the price of our goods, what would make it a bit easier for them to buy our goods? Well, essentially, if we lower the price, but without changing the price, what we're doing that way was we're lowering the exchange rate, so making it cheaper, appear cheaper, not necessarily for us to buy our own goods, but it seemed cheaper for them. So, therefore, it would we'd need a lower exchange rate to have a current account surplus. So, low exchange rate. This pen is awful. The quality of foreign goods and services increase. Oh wait, no, actually, sorry. That should say, I've just realised that. So, for a deficit, import more than our... Yeah, no, sorry, that was it. I crossed it out, it's not good. So if that's the equality of foreign goods and services, for a deficit, we'd be importing more because it seems more attractive and the quality is better. But if it's worse, so if our quality is better, they're going to want to export more of our goods, and alternatively, simultaneously, as their goods aren't quite as good as ours, we're going to, what's the point in importing it? It's probably going to be more expensive. So what we do is we buy our domestically produced goods. So we're not exporting any less. In fact, we're exporting more. But because of the people in the UK, they import less, so the imports are reduced and the exports increase because of the low exchange rate, and the quality seems better. So basically, to a foreigner, it seemed cheaper and it seemed better quality. If we're assuming the exchange rate is simultaneous, so the quality of UK produced goods increases. So quality and quantity, but I'll just write quality of UK goods increases. accounts increases. So they're the main parts, really, of the causes of surplus and deficit. What we're going to do now is we're going to go into a bit more detail about each of these. So hold on to your hats. We can find a little thing. Right, there we are. So we've talked about the causes. So we can use this to determine the positive and the negative effects on the current account. So just make sure I get this right before I waffle on any longer. So a deficit on the current account is good. Inflation pressure. Yeah. So we're going to start with deficits actually. So deficits, I just put advantages here. So if, in terms of a deficit, if we have, obviously our exchange rate is going to be higher, so there'll be less. Is that a deficit? Yeah. Sorry, just going over my head, it doesn't make sense. Yeah, because there's less money coming into the UK because the quality, there's more debits going out of the UK, so money. And we're going to be less money supply, there's going to be less money in the UK. So if the money supply decreases, so there's a lower money supply, or supply of money, whatever you want to call it, money supply. This leads to, obviously, if the money supply is less, people are going to spend less, so aggregate demand shifts, because, so aggregate demand is decreased, and if we use our short run, actually it's probably not a good idea to do it there, but I'll actually draw it. But your short run aggregate supply curve, if the aggregate demand decreases, what you have is a decrease in inflationary pressure. There is another thing that goes along with that, but that isn't an advantage, that's a disadvantage. So just assume that we're just talking about, for the advantage, we're only talking about good things. So there's a reduction in inflationary pressure. Or you could say a demand pull inflationary pressure, to be precise. But as long as you put there's a decrease in inflationary pressure, you draw the diagram, say it's been reduction in price from P to P1, you'll get your marks. So there's a decrease in inflationary pressure. If there's a decrease in inflationary pressure, prices fall in the economy. So that means the living standards increase of the people who still have the job. Living standard, which is good. Standards generally increase in the economy. And if the prices fall in the economy, we are increasing our international competitiveness. So IC, which you could argue actually increases aggregate demand, but that's one you want to talk about, you can do. So, what about a disadvantage? Well, we sort of touched on it in the first advantageary point. We talked about aggregate demand decreasing. Now, it's great, yeah, inflationary pressure decreases, that's really good for the economy. However, if aggregate demand decreases, what we have is a reduction in real national output. So, it could show economic weaknesses. Yeah. So, decrease in real national output could be considered to be an economic weakness. See if there's anything more on that in my book. obviously it depends on the duration. If it's small, duration, that's not bad. But if it's long duration, it's going to be bad because we don't want to keep. The government's going to have to raise money from somewhere, which we'll go into in a minute. So that's the positives and negative. So if we're spending more money than we're getting in, the government's going to have to borrow it from somewhere, as I mentioned just then. So the debts are going to increase. These are two separate ones, by the way. The debts are going to increase as we're going to have to borrow more. So the government's going to have to pay more repayments in terms of interest. And that's disadvantage there, and you could sort of expand that if you wanted to. So a current account deficit must be financed by something, which we talked about, the debts and the repayments there. If you we're going down that route, I should make that clear. It's just any repayments, that's interest repayments. As the government borrows money, it has to pay back interest on it for borrowing that money. As the interest rates, the cost of borrowing money, hence the government's borrowing money to cover their debts, pay more money out to these other countries, and that's caused increased interest repayments, which you could say has led to an opportunity cost. Now the surplus is sort of the opposite end of the scale. So if we're draw a line here. So we'll do the advantages in red and we'll do the disadvantages in blue. Crazy, I know. So your advantages of a surplus. So basically your disadvantages switched around for your deficit. So if you so we talked about here the money supply decreasing, and this leads to real national output. I should put output, decreasing. Now, for this one, if it's the opposite, aggregate demand is going to be increasing, as we're exporting more and importing less. Our aggregate demand is going to increase, which a disadvantage, which I'll go into in a minute, is blah blah blah, prices increase, which is bad. But real national output increases. So if real national output increases, demand increases. Because demand increases, and as labour isn't derived demand, or we can say if there's more being produced, there's more workers needed. So unemployment decreases or employment increases, up to which way you phrase it, of course. So we can say, I'll just put put increase in AD leads to a decrease in UE, which UE is short for unemployment. I'm trying to keep this room free, well, board free anyway. So that's one bonus, and obviously if people are buying more from us, we must be more competitive, so you can have that as another advantage, so more competitive. Even though our prices increase, our goods increase in quality, so I just put increase in quality. That must be one factor that's led to the current account increasing. So, what are the so disadvantage. So there are two advantages, and just like this one, we're going to flip it on its head. So a disadvantage. Now we talked about real national output decreasing here, which is increased here, which I'll just put increased real, real GDP. Sorry, should have put that there. So we talked about, and the disadvantage here is an advantage here of inflation, a decrease in inflationary pressure. So if aggregate demand increases, we're going to have increased inflationary pressure in the economy. So increase in inflationary pressure. So that's one good thing. And as well as that, I mean, you could probably talk about that. Yeah, sorry. I was just looking at if I've done something wrong, which I haven't. So, if we're in a surplus, we're using more goods now. So basically, it's great because we're actually consuming more. I should put that as another advantage. So, for this one, I'll just put it up here actually. As we're consuming more than we're producing. Oh, no, sorry. Right. So a deficit, when we're sending more goods from other countries to us than we're sending to other countries. If that makes any sense. So basically, for this one, sorry, I'll just make this a bit short. So for a deficit, basically what's happening is we are consuming more than we're producing, which is good because that means our living standards increase. However, for this one, because we're consuming less than so consumption is less than production. Sorry about that, my camera decided to die, which is very good of it indeed. Hold on, camera. So, as we were talking about, consumption is less than production, so our standards of living will decrease, and that's because obviously inflationary pressure increases, so our living standards decreases. Consumption is less than production. So I'll just that wasn't a good start. Yeah, obviously that invokes an opportunity cost. I'd put that in as actually. Put as an opportunity cost. If you can read this pen. So that's an opportunity cost as we're consuming more now than we did before. So there's an opportunity cost there. So that's basically all of the current account stuff. I won't rub that off because I feel it's fairly needed in this topic. I'll just get out of the way so you can read it if you can. I don't know if you can anymore. Yeah, I doubt you can read that. So basically, there's a couple of other things I just wanted to go through, which I'll just go through now. There's something called whatever that is. I don't know if you can see it. Protectionism. I can't even read that. It's not good. Protectionism. This basically involves the government and the policy and the balance of payments. It's great for the short-term protectionism, as basically it's protecting companies in the UK from competition. So tariff on imports. Obviously, that could upset the other countries in the long term, as it decreases the demand for their exports or imports what we're importing. So obviously they could respond violently with, well, not violently, but not very nice with that. But we could place a quota, which would set a limit on how much we could import, and that's a similar sort of thing. There's also the fiscal and monetary policy. The fiscal, government tax and government spending and taxation, and the monetary is to do with the interest rates. Now, if we change the spending power, then we can do this by increasing taxes, increasing interest rates, which decreases the imports, which is brilliant, which is what we want to solve current account deficit. But the problem with that, they don't just reduce their spending on imports. They also reduce their spending on domestically produced goods as well, which obviously is bad for the economy. Just another few things. The supply side policy. In one word, it's efficiency, and efficiency for firms. So it allows them to lower their price, increase their international competitiveness, sell more, increase exports. That is the best. Now, the first two, the protectionism and supply side policy, I'll say that probably better, they're to do with expenditure switching. So basically, switching expenditure from imports. In supply side policies, you just switch it from, you're switching it. And if you protectionism, you're switching it from exports to whatever you produce domestically. However, the fiscal and monetary policy is actually physically reducing the amount they spend, and that you probably say that's the worst, because that has a drastic effect on other goods and services the consumer might want to buy, and the standard of living will decrease, which could be bad for the economy in terms of the future potential, in terms of the education and healthcare, and that would have horrific consequences for the rest of mankind, of course. So, just to go over that all again, it's like a short summary. The balance payments is the record of economic transactions between one country and another. You have credit and debit items. Credit items are the transactions which involve the inflow of foreign currency. Debits are where our currency leaves the UK. An example of a credit item would be us setting up on a foreign country and sending money over there. However, the debit items are where a better example of a credit item, is where someone's working abroad and sending money back to the UK, or vice versa for the debit item. The current item is split. Current account, you've got the current account, the financial, the capital. The current account is split up to 4 sections. You've got the trading goods, trading services. They're 2 visible items. The services are invisible. The goods are visible. Obviously, you can physically see the goods unless you've got some problem with your sites, which is not saying anything there, of course. But sorry. So they're the first 2 it's split into. The current investment. So basically, this monitors the investment coming in and out of the country. So current transfers, which are payments to the EU. I mean, we get some of them some of the time, but it's very rare that you'd see that. So just go over that again. Split up into the current account is the trading goods and services, which are 2. You've got the current transfers, so the transfers to the EU and the incomes in abroad in the UK, which are credit and debit items correspondingly, I think. And then you've got the determinants of the current account, why we call it in a surplus and deficit. As you can read on the board, if you can't, I'll read it for you. So you've got the deficit caused by high incomes in the UK, low incomes abroad, the exchange rate being high, and the quality of goods and services being better outside the UK. And you can switch that around for the other one. The current capital account includes capital transfers, acquisition, disposal of non-produced goods. Basically, capital is government grants, acquisition, sale of assets. Sale of assets by embassy, so patents or whatever. Your financial account is the 3 types of investments. So you've got your direct, portfolio, and other investment. Direct investment is where we send money out to invest in foreign countries. The other one, portfolio, which is where you come and invest in the UK, and other is any other form of investment. So they're the 3 things. They're the determinants, they're the advantages, disadvantages that you can see on the board, and hopefully that's covered everything. We'll see you in the next video. Just before you click off, actually, I will do another video on the advantages, disadvantages of this. There's a pure one for that, so I'll add that up later, but I'll get this on first.